talk is called The Search for Profits, and I think I probably gave that title to the folks here months ago. I thought we'd be still searching for profits. We still are. We haven't gotten prices to profitable levels, but we're a little closer. Some of the key trends I'm going to talk about today. We're in a supply market, burdensome supplies of all crops. We don't have demand markets. Those are over. Makes it much more difficult to rally. We basically need weather. The funds, the big speculators, have been very bearish on commodities for over a year. They've started buying crude oil a little bit, but as of last week, they had a record bearish bet on in U.S. crop and livestock futures. So that can provide short covering rallies, and that's what we've seen this week. Make no mistake about it. The reason why prices are higher is the funds are buying back their short positions. It's not end users, chasing the market. China continues to hang over the market as a big issue, and that isn't likely to change, I don't think, anytime soon. We've got the El Nino. I'll talk a little bit more about what that may mean for prices. Profit margins obviously are squeezed. I think there's a shot at getting prices up to a point where you can make a profitable sale, however. And the safety net, we hadn't really paid much attention to the farm program for several years, but it's back. It's got some holes in it. Illinois farmers, particularly this part of the state, got better ARC payments in 2015, but that's because we had lower yields. And the strong dollar, also a factor that could dampen rallies this summer. So it's a whole list of problems. And I'm actually, when you hear people talk, I'm one of the more optimistic people out there. I was not a commodity classic last week, and I sounded like I was wearing rose-colored glasses compared to everybody else. I'm not that optimistic, but I think there's going to be a chance. Now, the big news this week, we had a supply and demand report, came out on Wednesday. This March report typically doesn't produce a whole lot of news, and this one really didn't either. USDA raised soybean stocks 10 million bushels due to weaker crush. I'll talk about that in a little bit. No changes to U.S. corn and wheat stocks. So, record supplies of wheat. This is the most amount of wheat we'll have around on May 31st, basically in history. Soybeans, also extremely burdensome supplies in terms of stocks to use, about as high as we get. The corn market, the stocks to use ratio of coarse grains may not seem like it's all that burdensome compared to where we've been in the past, but we really live in a just-in-time world now. Somebody's growing this stuff all around the world, and end users have gotten very comfortable. If we don't have a crop, somebody else is going to do it. They're going to do it in South America, the Black Sea, Europe, someplace. So as a result, supply markets, for corn, we're stuck in a downtrending channel here for a year or two, and we're basically in the middle of that channel now. Held some really key long-term support, and that gives us a little cause for optimism in corn. For soybeans, just too much competition. We remain in a downtrend there. Finally got July ticked a little bit above $9 today. And wheat, again, real long-term bear market in wheat. Held the support 440, 450 on the Chicago chart. If that breaks, wheat is in really big trouble. Now, the government program, the base prices were set there in February. They're going to be lower for both corn and soybeans, basically guaranteeing you only a loss. But it's still important to buy up, particularly around here, as much crop insurance, that RRP, to as high a level as you can to get downside protection and some upside protection in case you're making sales. ARC payments here were pretty good. This is my estimate based on the yields that USDA reported back in February. Looks like $85 to $95, not uncommon around here. For soybeans, a little bit less, $60, $65 around here, but you can see some growers in Illinois didn't get anything. So again, the the effects of that ARC program vary not only depending on what your yields are and what your revenues are, because price is important, but also just whether or not the 5 years that they're using, if you had 2 bad years, you lose. So China. This week the news in China was they were having their People's Congress. And they meet once a year, about 3,000 party members to rubber stamp whatever the leadership wants them to rubber stamp. So they outlined some reforms, some stimulus measures. All of this taking place in the midst of a really tumultuous stock market over in China. People started to take note in August when the Chinese stock exchange, which nobody really paid much attention to, really started to tank. And then, now one of the things I always forget to do when I start talking, I forget to start my timer. And this will tell me when I'm done. So we broke in August. We rallied back because the government borrowed a lot of money, stimulated their economy. Started to sell off again, however, here after the Chinese New Year. Bounced up over the past week because the Chinese government is telling pension funds, large investors, buy the market. So the government propped things up. They did this also right before the Lunar New Year holiday. So the question now is, when things get back to normal next week, what's going to happen? Are investors going to try to sell this market again? Still unclear about that. This is not the first Asian financial crisis. We had one back in the 90s. The stock market languished for 3 years. Corn and soybeans also moved lower during that time period. Now, not just because of the financial crisis as it moved around the world to China, Russia, a lot of other countries, but it didn't help. It certainly tamped down our export markets. Soybeans did the same thing. So China, they've got a whole host of problems. Weak manufacturing. They've tried to slow down their economy. The question is, have they done that too well? Are they going to have a hard landing? A lot of debt. They've been financing this recovery the last few years by borrowing, so they have trouble. Problems with pollution, corruption. This guy was their propaganda minister. So it tells you, they don't like you, they just arrest you for corruption. It's probably true. An older population. China had a one-child policy under Mao. They're starting to relax that, but they lost a generation or two. They don't have a lot of young people, and economies need young people to be growing. They're trying to shift from an exporting economy towards one that's driven by more consumer demand, service demand like we have here in the U.S. That's tough to do. And they're also, this is the leader, President Xi, says they're trying to transition to a market-based economy. The trouble is, every time they say that, the stock market continues to have troubles. They do things like devalue their currency with basically a meat cleaver that doesn't give anybody confidence. Now, obviously, charts compare soybeans to the Shanghai Stock Index. A very high correlation in August. That makes sense because they're our biggest customer. Correlation also increased during this latest sell-off, but less so. The market seems to be coming to grips with this. So this is good news. We're starting to put this behind us at least a little bit, but when bad headlines happen in China, it can still cause our markets to sell off. China buys everything. So not only soybeans, but crude oil, iron ore, coal. So what we've seen around the world is as their economy has sputtered, this is the CRB commodity index, made a 13-year low here over the winter, started to rally because we've had a rally in crude oil. And if you're an optimist, you think this is the tip of the iceberg of what could be growing interest in commodities. Like I say, the big speculative funds had a record bearish bet on in the ag commodities as of last week. They have been short covering fairly aggressively this year. That's top line, the purple line there, that's the index funds. Now those are the pension funds and other people. They're only long. They've been getting out of agriculture really for quite some time. They don't want to be accused of speculating on food. To a certain extent, they've also been doing this in the energy complex. Now, crude oil market, the crude oil really looks like it started to turn, bumped up to the 50% retracement of the sell-off here just this week. So we're kind of at a turning point now, and the question is, again, is this just basically a short covering rally, or have we finally hit bottom? The U.S. is cutting production. OPEC says it wants to slowly cut production. Some other countries are having trouble maintaining production, such as Nigeria and Iraq. Iran has started exporting again, but more slowly than the market had feared. So there is some expectation maybe that we made a bottom. Smart money, again, they've started buying crude oil. That blue line, that's the managed money, basically the funds. So they have started buying again. That's what's helped prices up. Another newsmaker next week, Federal Reserve meets. They raised interest rates for the first time since, 2006, 25 basis points in December. The initial plan was to keep raising it a quarter of a point every 3 months. The market, at least the federal funds futures, say there's no belief that the Fed will ratchet up next week. What that does is that can affect the dollar. Sometimes the dollar rallies because it's a safe haven. Sometimes the dollar rallies because there's optimism. Sometimes the dollar rallies because interest rates go up. So as interest rates start to rise, people like to buy dollars, especially when you have we have the European Central Bank. They have negative interest rates. If you want to park money with them and you're a big bank, you have to pay them. And they raised that fee yesterday. So as the dollar goes up, as the interest rates go up, that's going to tend to attract money to the dollar, particularly in this weak currency market. Now, there are $2. When guys like me talk about the dollar, we're talking about the dollar index that's traded in New York, only composed of 6 widely traded currencies. The real dollar, that top line, the Federal Reserve puts this out. It compares the dollar versus the currencies of 26 of our largest trading partners. You can see how that's really been getting a lot stronger. The broad index is relatively flat. So this is the real impact of the dollar, and it affects commodities because it tends to lower the price of commodities denominated in dollars. More importantly, it saps the purchasing power of countries that would buy our products. And we're seeing a lot of countries, big importers like Egypt, they basically don't have money to buy right now, and that's causing some problems. So again, the correlation between the dollar and this is corn. Sometimes it's very strong, sometimes it's very weak. It goes up and down and varies widely from day to day. Sometimes we kind of use it as a whipping boy, just because I have to tell you why prices went up, why they went down. I need a reason. I use the dollar. But it does have an impact. This is the stocks to use ratio. On that left side, that's the average cash price. The bottom side, that's the stocks to use ratio, how we measure supply and demand. You plot those points out for the past 15, 20 years, and you draw a curve that has a statistical significance. And that's the price curve. And you figure out, well, what's my stocks to use ratio? You go up to prices, and that's what your average cash price should be. Now this is where it's at, where I'm at for 2016. And again, I think there's a shot at $4 cash corn. But when you figure this same index and trade with this trade-weighted dollars, lowers at 40 to 50 cents. So again, if the market becomes focused on currencies and the dollar and deflation, it's going to lower price expectations. That's why I have a pretty large price range. So China's important. To soybeans, they control 2/3 of world exports. Strong correlation between their GDP and what soybeans they import. As the GDP has gone down, their imports the pace of their increases in imports have also slowed. Right now, we're at a 2-year low in terms of where we should be in terms of our soybean commitments, and next year's sales are at a 5-year low. Very weak, very few 2016 sales on the book. One reason is because China's buying actually more soybeans. Their purchases are up 13%. Those beans are coming from South America, not the US. Our sales to China are down 10%. So they're actually buying more than expected, just not from us. Brazil, one of our big competitors, these red bars mean they're in a recession. They've got a whole host of problems. It doesn't look like it's getting better anytime soon. That caused their currency basically to lose half of its value. Now, it's actually started to come up the past 2 weeks. It's up about 7% because things are so bad, it looks like their president is going to get impeached. And that has people optimistic that maybe they'll be able to make some changes. So what does this mean? When you convert the price of soybeans that the farmers there get, when you compare that, when you convert that in from dollars into real, that weak real increases the value of their soybeans. And earlier this year, soybeans were actually pretty much as high as they ever get. Since the currency has strengthened, they've come down. And this is for 2017, so this is next year's crop. So if their currency continues to strengthen, it could be good for you guys because it gives them less incentive to expand. So this is why farmers in Brazil really watch the currencies a lot, and you should too. They planted as many acres this year as you guys did, and they're the world's largest exporter now. And that really isn't likely to change anytime soon. The question is, what's Argentina going to do? This is their currency, it's the peso. They became international pariahs in 2002, devalued their currency, reneged on their debt. Nobody would lend them any money. Those lawsuits finally, 13 years later, just got resolved. Their currency continued to weaken. They elected a new president who's more friendly to business. He's letting the public, including farmers, own dollars so they don't have to just use pesos. So they've been hoarding their soybeans. They're selling them like crazy now. They may, due to a better export tax situation, plant maybe fewer soybeans, more corn and wheat next year. So that's something to watch there. Now, last year they were hoarding soybeans. Argentina didn't export as much soybean meal. We exported our exports at a record level. That's the blue line there. This year they backed off because Argentina is exporting. That's one reason why we have weak soybean meal prices. The crush is weakening. It started to tail behind a year ago, 5-year levels. That's why USDA lowered its export of crush. Soybean oil has been kind of the strongest component in terms of the products. It's getting a boost from this black line, which is palm oil in Malaysia. Price of that has gone up due to El Nino production problems. Also because their currency, when China devalued their currency, these guys did too, to keep pace with them. So that increased, that gave farmers incentive to try to boost production there. So profit margins for soybeans, the crush margins are at the lowest that they've been in more than a year. The processors are losing money. So for old crop, I think minimal rallies are probably in order. In fact, we could even increase carry out a little bit. For new crop, however, if you guys don't plant too much, and I think you'll probably plant less soybeans. I'm doing a survey right now. We'll release that March 24th. If you guys cut acreage a little bit, we bring yields back to normal. We chop more than 200 million bushels off the crop, and we finally start to whittle away at carryout, produce potential for rallies, but we're still going to have large supplies. I don't see that changing in soybeans anytime soon, unless we have a really bad crop. July soybeans, we made an 11-week high overnight. If you follow if you get Farm Futures Daily, I said time to sell some old crop beans. We've had a nice bounce. chance maybe to get up to a 920 on this rally. This is the seasonal trend. The red line there is the average in a year of normal production. On this rebound rally, we normally only get back up to where we were in the late fall time period. So that's why I'm saying maybe 920 on this rally. It's going to be hard to rally it any further until we get into the growing season, and it's too risky, in my opinion, to be holding a lot of soybeans that long. Because if we don't have weather trouble and have a good crop, then prices are going to start with a 7. Basis is pretty good. This is the basis along the Illinois River. It's not some of the crazy strong basis that we've had when supplies are tight. It's about average. The volatility, options volatility this winter was about as low as it got. That means options are cheap. They're still relatively cheap. If you're using commercial storage, you're way better off just selling the cash and buying a call. If you want to do a basis contract on inventory, put options are also cheap. You can get a couple months protection there. We got November soybeans finally broke above $9. So that's good news. We moved above the 200-day moving average. That opens up a little bit more, the door to a little bit more buying. This rally is right on schedule. Normally we get one after the February lows. Seasonal trends indicate at least some potential for rallies into summer. So for new crop, not too excited about selling new crop until we really get into the growing season. Soybeans, again, a record bearish bet in soybeans from the big speculators. That's that green line. They've been covering those positions this week. Okay, talk about corn market. China also a factor there. They have basically a year's supply of corn on hand. They've been giving their farmers very high prices. Earlier this year, this is the price in Dalian. They're one of the key ports in the futures market. They had over $9 corn. Government said we've got to lower the price we buy the corn from farmers. They knocked it down 10%. Prices broke. They announced plan they're going to cut it another 10%. This is the price for the 2016 corn. It's at a point now where it wouldn't make any sense even if they allowed it for U.S. corn to be imported after they slap a 65% tariff on. So U.S. corn sales to China have basically been non-existent the last couple years. Started with the whole GMO thing. They used that as a wedge. They've kept that up. They're not even buying from Ukraine, and they have a long-term deal to buy corn from Ukraine that they're not honoring. So they have so much corn, they just don't want to buy it. So that's not going to happen anytime soon. What may happen, however, is they're talking about fallowing 20% of their land in coming years, trying to reduce pollution, stress on the land. You know, about the time they do that, cut the price so farmers get less, then they'll have a drought, then they'll import from us. So they have been importing sorghum. This was the big crop last year. Prices hit an all-time high, but the farmers went out, planted more. So we're actually using sorghum now in the ethanol plants. That's holding down the use of corn. We still have strong use, but it's not growing. We had a situation this week where the stocks went up even though production went down on ethanol. So we're starting to hit a wall there. The margins for processors, these are the Illinois processor margins, ethanol plants, again, pretty weak, nothing like they have been in the past. Livestock demand is flat. USDA reports stocks March 31st, maybe a little better than expected, but it's not growing. Exports off to a fairly slow first half of the marketing year, basically about as low as we get, you know, unless there's a drought and prices are high. And next year's sales in next year's crops also at a 5-year low, so not a lot of 2016 sales on the books already, and that's a worrisome sign. These are the export inspections, come out weekly, starting to get better. So I think there's optimism that USDA may be right with its forecast, and at least that segment of demand won't increase much. But the trouble is right now, people around the world are using less corn. They're using alternative feeds, or they're growing it themselves. Less corn is moving in the export market worldwide, and our share of that market continues to go down. May pop up here a little bit over the next couple of years, but places like South America, Ukraine, just growing more of it and really competing with us. And plenty of feed wheat out there too. And this is one thing livestock producers around the world have learned, is to take whatever's the cheapest ration, they're going to use it. So this is my big supply and demand table for corn. Again, for 2015, I don't see prices really doing too much here till we get into the growing season. I don't think there are going to be major changes in the supply and demand balance sheet. But when we talk about next year, if farmers basically only add about 2 million acres, basically plant what they would have last year, we don't increase production much, and if you use a more conservative yield than USDA is using, I'm using 163.6, that's a 20-year trend, then you start to cut production and get production down about 1.3 billion bushels, and you can start talking about some price rallies. Again, the average prices could swing anywhere from 380 to 420, depending on that dollar if this scenario plays out. But it does start to get futures rallies, and that's the bottom numbers there, starts to get them up to the point where you can hedge for a profit. So in terms of July, this is the old crop contract. Looks like we made a cycle low. We tend to do that every 8 to 10 weeks. So we were 8 weeks out last week, and looks like we've made our low. Getting this July contract back to $4 looks like a stretch. That red line, that's the average year, when we don't have a drought or anything like that. We get a little bit of a rebound here on this March rally, maybe into early April, but basically just get up to those fall highs. So I think $4 still looks like a stretch at this point for old crop corn. I think you just have to keep whittling away at it, just like soybeans. The basis has actually been pretty good. It's been flat lately, but it hasn't broken. So the pipeline's starting to reopen. The river will open completely next week. So shippers are still bidding up. And we have a situation where this is the spread between March and May futures. It's down to 0. So the end users still need corn badly, so they're bull spreading. And that's a sign when somebody wants your corn, it's time to sell, at least on the cash, at least locking in the basis. If you want to be optimistic, this is that Illinois River cost of shipping grain. It's cheap, and it's flat all the way through the end of the summer. So there's little hope for basis appreciation based on freight rates coming down, because they're about as cheap as they get. The world where you're going to be competing with the river. Corn options, the volatility there has come up a little bit this week, but again, it's pretty low. So really doesn't make sense to use commercial storage on corn. And even if you're holding it on farm, you're probably better off limiting risk. And if you want to be bullish, do something in the options. I actually like using the December options. I recommended covering 50% of your 2016 crop with buying a $4 call, selling a $5 call, about 15 cents. Give yourself some upside in case we do have weather problems. It'll also make it easier to sell. The December contract, kind of in the middle of the range here, trying to hold, trying to turn higher. I think we will, but we don't need to rally to buy acres, so we're really talking about some sort of weather rally. Again, short covering, the funds had a record bearish bet on in corn as of last week, buying that back, helping to lift prices. The seasonal trend for corn, this is the one that's kind of disturbing, the black line here going down. Normally we hold pretty steady this time of year, but again, with that burdensome supply, end users don't feel a rush to bid up the price. Typically we get some sort of summer weather rally, and I think there's potential in that this year. El Nino caused disruption all over the world this year. Same chart that the other Bryce had came out just yesterday, the updated El Nino forecast. I'm not necessarily banking on a La Nina to develop that would again been associated with some of those big time droughts. But if the El Nino ends by the growing season, and there's an 80% chance of that, it does increase potential for below average yields. And that would be enough to stabilize the market. This one forecast I look at for the summer, again, showing above normal temperatures out in the upper Midwest and kind of dry all over. So there is potential for rally. This particular chart looks at the temperature distribution different years. You can see when there's a La Nina, we do have warmer temperatures. This is northern Illinois. But even when we in the neutral phase, we're warmer than we are during the El Nino. So that again could create a few weather scares if we start getting some warm forecasts. For temperatures, definitely drier in the La Nina phase. In the El Nino, we can have a wide distribution, sometimes wet, sometimes dry. Could get both this year. Again, too wet, too dry, it causes potential for rallies. So what are the odds? I looked at just below average yields and then a 5% reduction in yield with a La Nina event. Definitely potential there for corn. But again, even with just a shift to neutral, we have better than average chances for rallies, about twice. What that means for corn targets is if you take a 12% rally, and that's the average rally, that could get you up to about 470. And 75-80% chance of that. A 5% rally, that's the median. That means half the rallies are above that, half the rallies below. A little bit more conservative. That'd still take us up to 440. And again, 75-80% chance of that happening. So I think there's at least some cause for optimism. This cycle has a little less of an impact on soybeans, a little harder to make the case. But again, above average chances for below normal yields and even a 5% reduction in yield. The targets there, the average would be 1035 and the median about 1070. So those are some price targets to start thinking about. Now, we've had 3 good corn and soybean crops in a row. We've only had 3 good corn crops in a row, or 4, twice. One of those was in the 1980s, which you may remember. For soybeans, we've only had above average yields 4 years in a row once. So the odds favor average or lower yields this year. This is the ratio of soybeans to corn. Basically 236, that's the long-term average. So neither one is really attracting anything great right now. Cost of production, this is the U.S. average. It's down this year, still not down enough, but due to lower fertilizer costs, it's knocking $35 an acre off the average cost of growing corn, obviously less for soybeans. Fertilizer prices broke sharply over the winter here in Illinois. That's reflected a big break on international markets due to the strong dollar, weak demand, low crop prices around the world. Farmers are skimping. They're cutting back. Ammonia prices here in Illinois are still on average higher than they are out in the plains, where we saw some costs in the $420 to $450 range. They've got more production out there and lower transportation costs, so that helped them. Crude oil stocks, we set another record this week, but U.S. producers starting to cut production. So that, again, turning the mood in this crude oil market. And we actually have record supplies of Midwest diesel fuel right now headed into spring. Unfortunately, prices are going up due to this rally in crude oil. So typically the best time to buy diesel is in January, February. If you wait till March, that's when farmers start buying. That tends to buoy the market anyway because you guys are the swing factor. Propane, we had a huge overhang of propane supply, record propane supplies. They're still relatively large, but as producers, these crude oil, natural gas producers cut back on their production, that means we're getting less propane as well. It's a byproduct of that process. So propane supply is actually starting to tighten up here a little bit. That means we've probably seen the bottom in propane, made a 13-year low this winter. We've rallied back since then. Again, propane tends to follow crude oil. If you haven't locked in your propane yet, probably the best time to do it is to wait more towards the summer. We should start to build up that surplus a little bit. Again, this is going to follow crude oil. So when we start talking about profit per acre, this is nationwide. I'm a little optimistic that the average grower in the U.S. might be able to make a little money in corn. If we can get a decent rally, we don't get a huge crop. Soybeans, wheat still look like money pits at this point. Now for Illinois, your high costs hurt, particularly the high land costs. It's about a $4. I'm at about a $4 loss in corn, 50 or so in soybeans. So again, corn looks like a better choice, has a better safety net from ARC, and better chances for rallies as well. I update all this stuff on a pretty regular basis. Most of these charts are online. We offer twice daily newsletters as well. Farm Futures Daily, you can sign up for that. And my Twitter feed, like Todd mentioned, if anything breaks, I put it up there first. And with that shameless plug.
Shameless plugs are good. Ready for any questions? Anybody got a marketing question they want to ask Bryce? Surely you do. Just sad news. There we go.
All right. We know that crop insurance is pretty much going to guarantee us a loss. What is your position on you thinking of the price flex where you can get 2 week or month increments like July, July, something like that?
Yeah.
Repeat the question.
In addition to the traditional types of crop insurance, revenue protection, yield protection, private companies are offering short-term window protection during different points during the growing season. I think these are interesting concepts. We don't have a real good track record to know how well they work. The only trouble with that is that again, that might protect against yield loss, may not do anything against revenues. And one thing, with the markets, we always used to say corn would make its high on the 4th of July. Some years it does, some years it doesn't. The highs can come almost any time in corn, except for November and December. So I think those private crop insurance plans are interesting. I still think they're somewhat speculative at this point.
Other questions? All up, all done. Bryce, you covered it all very well. Thanks so much. Give Bryce Knorr a nice round.